Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's episode, I'm going to give you a guide for capital budgeting. And if you watch my previous episode, then you're going to know that this is the first decision that we want to make with corporate finance. And it's basically going to tell us how should we invest. So where should we put our money in any company project? And so what we call it in finance, it's going to be capital budgeting. But first thing that you should consider is that capital budgeting is thought as a process for valuing projects. But every decision is technically a project. And therefore, all the alternatives and outcomes should be considered when we are trying to take any decision. And that's why in this case, it's going to be like a project. So it doesn't necessarily have to mean building a new product for it to be called a project. It might just be hiring someone new. That may be a new project because it's a decision, and we always have to consider all of the alternatives that will come. If I don't hire someone, what else could I do? Or all of the outcomes that will come. So if I hire this person, how much value am I going to get from that person? So for starting, I'm going to mention just some concepts, financial concepts that we're going to have to keep in mind throughout the episode, because these ones are going to be leading to many calculations. So first one, and I'll go back to accounting, so throwback, it's going to be the EBITDA or the EBIT. So EBITDA, it's going to be revenues minus costs, and the EBIT, it's when you already take out depreciation from this EBITDA. So these two concepts are going to be relatively important. You can either remember one of them. I think EBITDA is a bit easier, just revenues minus costs, because for this ones, we're going to use them for calculating our free cash flows. So very important. Second concept is what I was just anticipating, free cash flows of the firm, because these ones are the ones that we'll care about. So for calculating the free cash flows of the firm, we're going to take the EBIT and we're going to multiply that times 1 minus the tax rate that you're paying, and then we're going to add depreciation, because depreciation is technically not money that's flowing out of our pockets. We still have that money. And then we'll take away capital expenditure, which means all of the money that you spent buying long-term assets, investment assets. And then we're also going to take away the change in the net working capital. So this is a simple formula that you should memorize, because the free cash flows of the firm are going to be very important for calculating the value of the firm, which is what I was talking about in my first finance episodes. But here I'm going to take some considerations. First, for the free cash flows of the firm, you should never include sunk costs. And maybe you've heard about these costs, but there are some that included in the past, but we shouldn't include them because technically these are costs that we incurred in with or without the project. So let's say I am a company and I'm hiring McKinsey to do this study to see if I should open in a new market or not. I already paid for the consulting thing. Whether I open or not, it's going to be my decision, but that cost already happened, even if the project happens or no. So that would be an example of a sunk cost. If it's something that's not technically related to the outcome of the project, then this one we're not going to include it. All of the ones that we're going to include in these scenarios are going to be called the incremental cash flows. And so these ones will be directly impacted only if the project is done. So for example, I can calculate the sales that I would get from that new market, going back to my McKinsey example, because that is only going to happen if I do that project. If I don't do the project, I won't have sales in that new market. So there are going to be two different types of costs that we should have in mind. Do include incremental cash flow, no for sunk costs. And so now that we already know some of the basic things. In my first episodes, I already told you that we had 2 measures for assessing if a project is valuable or not. This were the net present value, also known as the NPV, or we had the IRR, which was the internal rate of return. The net present value is going to be accounting for all of the value creation, while the IRR is the internal rate of return, which technically means the rate of return at which net present value equals 0. That is the mathematical way to get it. So when you have these 2 measures for many projects, which one should you decide on? Which one is better? Response is always going to be NPV. Net present value is going to win above everything else because, just as I was saying seconds earlier, NPV will account for value creation. IRR may actually be misleading sometimes because it simply calculates the percentual return, and since this is defined mathematically, for some projects you may even have more than one IRR, especially in these types of projects that have changing cash flows. So let's say I invest first some money, then I'll receive some money back, then I have to invest some more, then I'll receive some money back again. When we have all of these changes in signs of cash flow, so you're getting not only negative, positive, 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 but we're gaining negative, positive, and then another negative somewhere, and then another positive, then this is going to lead to actually multiple IRRs. So when you are in a meeting and someone is mentioning that high IRR is going to be the decision for incurring in a project, you should actually be questioning these statements because IRR does not hold the truth of value creation. It is just a percentual calculation done with math, but it doesn't hold the value that's being created. So IRR may be very unreliable. Be careful on that. Also, one thing that tends to happen with IRR is that it will usually favor smaller and shorter projects. So if the project is for a smaller scale and it will take longer to pay back and has a smaller investment, then this one's going to have a higher IRR. And that doesn't necessarily mean that a small investment is going to be always the best. So always choose for the highest NPV because this is going to account for your value creation. Other stuff that you should consider when choosing a project or not, besides NPV and IRR, are going to be your opportunity costs. And I'm sure you've heard this concept a couple times, but opportunity costs are the result of choosing one alternative over another. So basically the potential foregone profit of the missed opportunity that you didn't do.
How long have these meal kits been in my fridge? 1 week? 2? How much am I spending on these? Hey, Erica, did my subscription go up?
When your questions about life turn into questions about money, there's Erica, the virtual financial assistant to help you spend, save, and plan smarter. Only from Bank of America. What would you like the power to do? Erica is only available in the English language. You must download the latest version of the mobile banking app, only available on select mobile devices. Your chat may be recorded and monitored for quality assurance. Message and data rates and additional terms may apply. Bank of America N.A., member FDIC.
So for calculating this opportunity cost, you should always compare with different alternatives. And for example, if this is a new asset, you can use the opportunity cost as the full cost of that asset because that could have been money that you had in your pocket. If it's with an existing asset, then what you should consider is what is the best use of this asset? And basically, if you calculate the NPV, you can use that as your opportunity cost. So always look for alternatives. Now, third thing, after NPV and after opportunity costs, we should account for limited resources. And for this, I'm not only talking about money. I believe actually money is one of the few unlimited, quote unquote, resources because we could potentially borrow or raise more money, but we don't have enough time. We may not have enough skilled workers. We may not have enough people that are going to be dedicated for this task. So there are other types of limited resources that you should consider. And for this, what I suggest is doing a profitability index. And this is usually talked about as the PI ranking. And what you have to do is basically calculate the NPV and the resources that you're going to need for each of the projects. Then you're going to do a ranking based on the highest NPVs and goes up to the lowest NPVs, and you're going to allocate resources only to the top projects until you run out of resources. So whether that's people, time, etc., you say it, you're going to allocate it like this. So I already gave you a couple things to consider when deciding if a project is good or not. NPV, IRR, opportunity costs, and the profitability index for limited resources. But now, there's one important caveat that probably you were thinking about, and it's which discount rate am I going to use for valuing each of these projects? For different projects, you might think that they may have different risks involved, and so we're going to use a different discount rate. And this may be true, but may also be not true. And I'm going to explain to you why. If you remember the WACC formula, or the cost of equity formula specifically, this one, the only thing that you could change was basically the beta. How much was the risk that was associated with the market? And the beta was usually tied to the industry. So let's say I work in the food industry, I will have one type of beta. If I work in the hotels industry, I'll have another type of beta. Or in the insurance industry, I'll have another type of beta. But what you have to consider is that if the project that you are calculating for doesn't change the firm's main operations, so let's say it's still going to follow the same line of business, then we should use the company's discount rate. And this one was the WACC. So only if it's going to open up a new division, so let's say I was an insurance company and now I'm going to open up a restaurant, then that would be changing my business line completely. So if it's that moment, we're going to use a different discount rate. There are other possibilities where we might need a different discount rates, and this are when we have to change the capital structure of the firm. And we'll talk about this a little later in another episode, but the capital structure is going to definitely change all of your WACC because you're changing the amount of debt that you're putting in. So overall, and as a summary, if you have the same systemic risk in your project as the firm's overall risk in a business line, let's say, we're going to use same discount rate. And also, if the project does not change your capital structure, we're going to use the same discount rate. Now, the last question that I want to address in my episode is going to be if you should include a perpetual growth rate or not. There are some debates around this, and in the first formulas that I gave you, you already know how to calculate the present value when you're giving a growth rate, but this is going to be a little tricky. If you have enough information, then yes, you should include it. But be careful when you're putting it for perpetuity, because perpetual growth implies that you're going to be growing forever with that project. And this is going to be very hard to argue, because a project may not make you grow forever. Also, second advice would be that underestimating the growth is a wiser approach. Why? Because if you put a big number for the growth rate, then this is going to give you, of course, more return, and it's going to make the project seem more profitable. So if you want to do the project, then maybe you should be overestimating it. But the wise decision would always be underestimating the growth rate. And the last advice, would be try to get it by looking at the business or industry. And maybe that way you can get an average, because always being closer to the average is going to make it less risky. So for summarizing, the three advice that I will bring for the growth rate is, First, don't make it perpetual. Second, try underestimating it. And third, try calculating it by looking to the average of the business or of the industry. On my next episode, I'm going to start discussing on how and what are we going to affect the WACC, and if this discount rate may be able to change if we take some decisions of others. But for summarizing today, I have NPV or IRR for taking investment decisions. I should also consider opportunity costs and limited resources. And the last thing is that you should always be careful about the discount rate that you're using, because if it doesn't change the business or if it doesn't require capital structuring, then you should always use the same discount rate as the firm. I'll see you in my next episode.